My name is Antony Bugg-Levine. I'm a managing director at the Rockefeller Foundation, and really am honored and privileged to be here today, both to talk about the impact economy and impact investing with this audience, and especially to share the stage with this panel. You might be wondering, some of you, I hope, are wondering what an impact economy is, what impact investing is, and why we're talking about that at a philanthropy conference. I just wanted to spend a few words to frame this discussion and then turn it over to a very accomplished panel to help us understand both the opportunities and the challenges that the impact economy creates. The basic premise of our work at the Rockefeller Foundation on impact investing and the work of many of the people in this room and on this panel is a realization that what has worked in the past and how we have organized our philanthropy and in many other ways the systems addressing social problems is not going to work in the future. And our basic recognition is that we have for many years organized our world around two basic principles. The first is that the only way to solve a social problem is through charity or government. And the second is that the only purpose of investment and business is to create wealth. Those two basic assumptions have led to a set of systems. We have a legal system that gives us a tax break when we give money away to nonprofits, but doesn't know what to do with us when we are trying to pursue our social purpose through investment. We have an educational system that tells young people who go to business school, you're going there to learn how to get rich, and people who want to address social problems should go to policy school. And we have a money management system, the capital markets, that on one hand tell us how to make money, and on the other hand help us give away our money, but are really unable to help us integrate the two. Against that system is this new idea of impact investing and the impact economy. And what these ideas do is upend those twin assumptions, because what impact investors are starting to show with increasing confidence and breadth is that an investment can be an economically effective and morally legitimate way to address a social problem. And so if you believe that, and I think the people on the panel will show us how that's working, then those twin assumptions start to fall down, because now when we seek to solve social problems, we're not limited simply to charity or government. And when we look at how we invest, we can start asking, what is the social purpose that we're achieving with our investments? Once those assumptions break down, the systems break down, and we have to rebuild a new set of systems that honor the aspirations of the impact investors and those people participating in the impact economy. That moment of change and the turning point when a new system needs to change in response to a new set of aspirations is what this panel will cover. I couldn't imagine a better set of people to be on stage to help us think through the opportunities and the challenges created by this turning point. To my left is Ron Cordes, who is the co-chairman of Genworth Financial and the chair of the executive committee of Impact Assets, a new firm that he will talk about trying to help build up some of the infrastructure to address the new aspirations of impact investors. To his left is Kofi Adjepong-Boateng, who built his own investing firm based in Africa called First Africa Holdings, which he sold to Standard Chartered in 2009, and now serves as the vice chairman of Standard Chartered's African capital markets. And finally, to his left is Sonal Shah, who heads the White House's Domestic Policy Council's Office of Social Innovation. They really do represent three different perspectives and complementary set of perspectives and activities in this new world as a new set of systems is being built to honor the aspirations and capture the energy of impact investors. So with that, I think I'd like to start by turning to Sonal. And as I said, I think historically, we have felt that social problems are the purview of both governments and philanthropists to solve through charity and through direct intervention. Why is the White House and the US government excited now about working with investors and working to help harness the impact economy toward the issues we care about?
Anthony, thank you, and thank you all for coming so early in the morning and coming to listen to us at 9 o'clock in the morning. For me, it's now, it feels like it's noon, given that I live on the East Coast time. But quickly, I think the government has always recognized, at least from the White House's perspective, we recognize that government alone cannot solve any or all of our social problems. We are one part of the solution, not all of the solution. And we know that while we can do our piece of it right, we can't do every piece of it right, and nor should we be doing every piece of it. So from an impact investing perspective and why it's so important, we think about what our role is And we think there are probably two major roles that the government can play. One, get the policy environment right. So it's not just that we're thinking about grant making or business, but we can think that there's opportunities in between both grant making and business, working with philanthropy and working with the business community to think about how do we help address some of our social problems, not just looking at it from a pure philanthropy perspective or not looking at it from a pure business perspective, but where are the opportunities in between. The second is convening. We are the government. We have the ability to convene multiple players, to bring them together, to think about where the opportunities are and how we can do that. And here, we believe there's an important role for us to bring the players together to say, how do we help solve some of our social problems, but looking at it from multiple angles and what are the tools that are needed to make that happen. In some cases, there may be a role for the government. In some cases, there may be no role for the government. It may be just that we're a convener. And we can help through influence more than we can through doing pieces ourselves. And so from our perspective, we think there's a huge opportunity that is opening and has opened. I think it's already happened in pockets. This is not yesterday we thought about impact investing and now we're doing impact investing, but when we look at housing and urban development, when we look at education, it's already been happening in pockets. The question is, how do we build upon that?
That's great. Well, I think you mentioned we need to get policies right. I hope we can talk about that. And also around this theme of convening, for impact investing to succeed, people who are unused to working together are going to have to learn to work together. We're going to have to give up our skepticism and sometimes our self-righteousness about each other. And so I think we'll want to touch on what that means and your practical experiences with that. Before we get to that, I just wanted to turn to Kofi. You've heard from the US government that this is something that clearly will be necessary to be able to create the world we want to see here. As an African investor who's both active in the capital markets and also active in the long-term development initiatives in Africa, why is impact investing relative on both sides of your life for the investors you work with, as well as on the projects you're working with related to development in Africa?
Well, Antony, it seems to me that the idea that one has to make a choice between putting money into something that is socially useful and making a financial return is a false choice. I think over the long run, companies, both the long term and medium term, companies that deliver the most profits tend to be those whose goals are primarily to be socially useful. Good companies are companies that overall are deemed to be socially useful. And I don't think you find smart entrepreneurs waking up in the morning thinking about how to deliver financial returns. I mean, we're in San Francisco, so you can't avoid talking about Silicon Valley. But it'll surprise me if the founders of Google, and I'm terrible with names, but the founders of Google woke up in the morning and said, listen, let's build a business that will deliver great financial returns. What they did was they woke up and said, let's build the best search engine in the world. And I think this is probably true of a number of their peers in Microsoft and other places. It just seems to me that good companies are not companies whose primary objective is to do anything other than be socially useful. And in the long run, those are the companies that deliver the best returns and the companies which in the end achieve something which they may not have set out to achieve initially, which is great financial returns, but also making contributions to the societies in which they're based. Mm-hmm. So when I look at Africa and indeed other emerging market geographies, and I look at the opportunities in those geographies for quote-unquote financial return, it seems to me that the companies most likely to be capable of achieving those returns will be the companies that set out to be the best in their field, and almost by definition, the most socially useful, and certainly not companies driven by managers who think almost entirely about financial returns and not at all about the communities in which they serve, the usefulness of their products, the long-term loyalty of their employees, and so on and so forth. So as I say, I think it's a false choice.
Mm-hmm. So Ron, just to pick on this, we've heard from Sonal that the government is now excited over business. We've heard from Kofi that businesses, in fact, do create great social good, and so there's a false choice to have to think just about philanthropy or business. What does that mean for someone like yourself and your family who, I think like many people in this room, is trying to think about their own assets and their own work in a world where they want to be and you want to be addressing social issues with the full range of assets, both human and capital, that you have from your own life experience?
Yeah, so my story is fairly simple. In 2006, two partners and I had an opportunity to sell a company we'd created in the wealth management field. And in doing that, as part of that opportunity, my wife and I created a family foundation, which not unlike many of you in this room. And so it was an opportunity for us really to kind of structure our philanthropy. And for the first 12 to 18 months, we treated it much like most conventional foundations. We had a program team that worked on grants, and being in the wealth management business, I had a team that worked on actually managing the assets in the portfolio. In 2007, I started to really learn about this emerging field that was so emerging at the time it didn't even have a name. And Antony and I still laugh about this because the field really didn't coalesce until about 18 months ago or so, when through the leadership of Rockefeller Foundation, the name impact investing actually was kind of coined to put a framework around all of this stuff that was happening. But in 2007, I looked at, I've always been a huge believer in the power of the capital markets. And I looked at what we were doing on our grants budget, supporting economic empowerment in the developing world, human rights, a number of issues that we're very passionate about. And I went to our board and said, there ought to be a way for us to support these same issues off of our investment portfolio. I'm not sure what it is, but I'd like us to target a commitment over the next 24 months of a portion of the portfolio, and then let's go out, let's hire some people, and let's see if we can get there. I've never kind of been an incremental person, so the target that we set was 20%, which was a pretty aggressive target. And over the course of the next 18 months, we brought on a number of young MBA interns and others into our firm to augment some of the people that we already had that were looking at this, and went about trying to build an impact investing portfolio with the objective of significantly leveraging our 5% grants budget. That's really the way I presented it to our board is, if we can do this right, if we can allocate 20% of our capital towards solving these same issues that our 5% grants budget is going to, we can create 4-to-1 leverage. And I actually believe, and we haven't proven it yet, but I believe that we can actually create more than 4-to-1 leverage, because I think the rigor and the discipline with which the 20% is being applied may dollar for dollar end up having more direct impact than the 5% that we're granting.
That's great. I think we'll get to some of the challenges. Clearly, your journey involved much more effort and personal engagement with the team, describing hiring MBAs and so forth, than would be necessary if you were just doing something more standard with system support team. And I think we'll talk a little bit about the systems that are needed. But before we get to that and some of the challenges, just to finish this sort of part of the conversation around the vision. So how will the world look differently if impact investing really does take off? I mean, from your different perspectives, from the government, in Africa, and from your perspective as someone who runs a family foundation, if 10 years from now, many more people are doing what you did, many more investors are thinking about putting money to work in businesses that generate social good, and the issues that this audience cares about, how will both practically, where do you think this can make the biggest difference? And beyond the specific issues of specific geographies, what do you think the major differences would be in how we go about organizing around social problems?
So I kind of look at it as a little pocket and a big pocket. I think today that because of the kind of way we've compartmentalized how we solve problems, as Antony described earlier, we here in the US are working very hard and very diligently to solve all the problems of the world with a pocket that involves about $300 billion a year of combined individual and corporate philanthropy. The big pocket is about 41 trillion, latest number, of combined investment portfolios of all of the millions of families in America, foundations and individuals. And my goal is, over the next 5 to 10 years, if we could catalyze even a small percent of that 41 trillion, catalyzing 1% of the 41 trillion and having that invested for impact would more than double the amount of money, the amount of dollars that go to solving our most important issues. And I actually think that the diligence and the rigor and some of the thinking that would go around investing that, in that case, $410 billion, would actually potentially move us farther ahead in solving problems in a very scalable and a very replicable way. So that's really my objective, is how do we create an environment where it becomes the norm, not the exception, to include these types of impact investments in both a family foundation portfolio, a larger institutional foundation portfolio, and a portfolio perhaps of a family that doesn't have a foundation but is looking at how they can augment their philanthropy just out of their traditional investment portfolio.
I want to just add to that, and I think what Kofi had also said, which is, I think to the extent that we stop treating this as one or the other, it's either a grant or it's an investment, and we tend to run both of these in parallel and never in synchronicity. And so it's like, I'm going to make grants and I'm going to work on social issues as a grant issue, and then I'm going to make investments, and those have nothing to do with the grants I'm making. I think to the extent that we begin to see those two as working together and to be able to make grants or investments, and ideally build upon the grants to do the investments, because I don't think you can only do investments without looking at the grant side of this. There are some things that are going to require grants. And we're not going to make money off of it, but there should be opportunities, if those grants work right, to be able to create a market. And if we're not thinking in those two ways, then I think as a government, we are looking at both, and we have to look at both. We have a government, I think the economy in general, we've bifurcated all of these pieces, and we operate in our silos to the extent that we can start breaking those down. And I'll give you a couple of examples where I think we can do some of this. One, already in our healthcare group in HHS, they're beginning to release information that we have on what's going on in healthcare, but it's the private sector that's actually using that information to make changes. And while our job as a government is to make that information publicly available, and from a policy perspective, we should be making public information more publicly available. But how can we encourage the private sector and others to look at this, to say, how do we look at this data and help solve social problems, whether it's private or public, should not be a dichotomy and a false dichotomy that we create. So to the extent that in 10, 15, 20 years, we begin to not see investment as investment and grant making as grant making, but to see how those two can start working together as a government, but as a private sector, I think we'll go a long way, and especially with philanthropy playing in that middle role.
Yeah, I would agree with that. I think, to me, one of the things that always intrigues me is the extent to which, no matter how hard we try, we never learn from our mistakes. And if you want to understand what the world will look like if we continue to focus on trying to allocate capital to areas where we believe will give us the greatest return, all you need to do is look at 2008. Okay? Now, the chances are we will not do that. We will not look at 2008. So, how will the world be different? Well, I suppose as some sort of rational optimist, I've got to hope that capital will be allocated differently if we begin to think about returns differently. So in other words, to the extent that we begin to include in our capital allocation decisions questions such as, is this company one that is socially useful, that will serve a greater number of people, that is likely to be around in 20 to 30 years from the data I invest? Those sorts of questions, which may not necessarily be directly mathematically linked to calculations of internal rates of return, but those questions will give us a much better feel for the types of businesses that we should be investing in. Antony, as you know, one of the areas of research that I've been involved in looks at the response to the 1930s depression of a group of high net worth families in New England. Now, in my mind, it is not coincidental that the whole discipline of philanthropy and the discipline of venture capital came out of the same source. Venture capital wasn't some sort of fluke where a group of people in a room one day decided to back a bunch of unknown entrepreneurs. No, it was a very disciplined and organized collaboration between a group of high net worth families in New England and certain universities in New England to go out, search for entrepreneurs who believed in the businesses they were creating and to back those businesses. And it just seems to me to be a natural extension, that if you're willing to take the risk of a grant which by implication means you may not get your money back, then you ought to be willing to take the risk of a venture capital investment, which also may mean you may not get your money back. But in the end, the disciplines and the thought processes that go through selecting the type of entrepreneur that you're willing to back as a venture capitalist, to my mind, lead to better capital allocation decisions in the long run. And if impact investment as a philosophy and as an asset class achieves anything, I hope it simply allocates capital differently from the way it was done leading up to 2008.
That's right. So I see a lot of nodding heads, but I know that you and many of the people in this room who believe in these ideas are often in rooms where there are not a lot of nodding heads. At least they're not nodding this way. What has your experience been conveying this idea, whether it's to your colleagues in government who might be skeptical of business, whether it's to the wealth advisors you speak to who don't believe they have a responsibility to be thinking about social issues? In your own peer groups and in your professional networks, how is this idea being received, and what is it going to take for us to overcome some of that inherent skepticism, which I think is an outgrowth naturally of the systems having been built to support a different mentality over the last few decades?
Well, I'm happy to take that first, I guess. I guess first, just a quick backdrop, and that is that, full disclosure, we've now gone from 20% up to 29% of our portfolio in impact. That's the good news. The bad news is it's been really hard. Over the last 4 years, it's probably been one of the most difficult and perhaps frustrating in many cases processes that I've been through in my investment career, because the market is still new and fragmented, and the types of systems and infrastructure that people need to deploy capital don't yet exist. So what I see is an enormous amount of latent demand. Some of the surveys, Rockefeller sponsored a survey by a group called Hope Consulting that indicated that nearly half of the affluent high net worth individuals they surveyed were very interested in learning more about this field. It was with a major wealth management firm in New York, a firm we'd all recognized last week. They'd done a survey of their own clients. That percentage was actually higher. It was in the low 50s as a percentage. So there's an enormous number of people interested. Financial advisors, I believe, and I've talked to hundreds of them, including probably many of the financial advisors that you work with here, financial advisors are interested because they're sensing this latent interest among their clients, but yet they don't have the tools to have a conversation. So I often talk about why is it that the gatekeepers, as we call them, are keeping the gates so closed and locked. And to many of us in the social sector, many fund managers in the impact sector look at it and say, these financial advisors just don't get it. They don't have a social conscience. I've got to somehow work around them to get directly to the clients. I'm convinced that they do get it, but they need help in understanding it and operationalizing it and putting it in a structure and framework that they can actually do something with. And so that's really understanding and recognizing that over the last couple of years. That's what led our foundation to be one of the lead funders, along with the Rockefeller Foundation, in a new initiative in partnership with the Calvert Foundation called Impact Assets, which is a nonprofit social enterprise financial services company we're building to support providing the wealth management industry with the type of infrastructure that they will need, so that if you leave this conference and on Monday morning call your wealth manager and say, I'd like to begin exploring how we could address some issues in the impact investing area, that wealth manager, if they're not already attuned to it, will have a place that they can go to get the type of information and products and vehicles and support services they would need to actually come back to you and say, okay, here's how we would do it.
Yeah, I would agree with that. I mean, I think they do get it. I mean, one of the great things about being in 2011 is we're a couple of years after 2008. And nowadays, it's much easier to talk to people who've actually lost money about,
It's easier to find them.
Well, it's easier to find them, and it's easier to speak to them about the irrationality of the processes that led to them losing money. I mean, there is such a thing called the Franklin doctrine after Benjamin Franklin, which said, so convenient a thing is it to be a reasonable creature, since it enables one to find or make a reason for everything one had a mind to do. It's some sort of hindsight rationalization, and I think going up to savvy investors and saying to them, listen, let's think about changing the premise on which some of your investment decisions were made. Let's look for entrepreneurs who are looking to develop products which will have a mass appeal, which will have a wider appeal. Let's look for companies which are looking to build their businesses in ways that are socially useful, and so on and so forth. I think one is almost knocking on an open door. What is lacking is the infrastructure and the tools, and in some cases the research, to carry out the objectives that you described. So I would completely agree that the problem isn't so much changing minds or giving people with the right hindsight a reason to believe and to do the things that they would have done anyway. It's more supporting that through adequate financial architecture, for want of a better word, which would include research, which would include skill sets, and which will include capabilities that will enable these investors achieve these goals.
So I want to be slightly contradictory on this one because I think it actually does require some social change thinking. And I will start from the government first, and then I'll push on this a little bit. I think in the government, it requires us to understand what that means. We currently operate within a framework that we know how to get grants out the system door. We know how to make certain types of investments, whether it's new markets tax credits or whether it's CDFI funds or other types of investments through housing and urban development. But it's not just that tomorrow we're going to change it and it will happen. We need to train people to think differently. We need to help them understand how that means changing their job. It means working with Congress to understand how they might think about it slightly differently. The system's a fairly broad system. It's not one or the other, that if I, as a person in my office, can make this happen, it will change. I have to figure out how to work within the system to get the system to think slightly differently. And we've started to create the tools from a policy perspective. So most recently in the 2012 budget, the government has put in up to $100 million worth of authority for pay for success bonds, similar to what the UK is doing on social impact bonds, which bring in the private sector. We've started a conversation internally on impact investing. It required, and what was helpful was to have the framework that you all have put out on impact investing broadly, to at least start the conversation internally of what that could mean from a government perspective and a policy perspective. How do we align different portfolios to agree to the same sorts of definitions? How do we make sure that we can actually use private sector investment based on the legislation that currently exists, and what are the legislative authorities? But to be honest, what's really interesting for us is everybody, even from a lot of folks from the impact investing folks, come to us and say, what's the government going to do? And I come back and I'm like, well, this is the private market. Why do you want the government involved in every aspect of this? We should get the policies right. So I'm not sure that the investors are all there, and frankly, I'm not sure philanthropy is all there, because I do think we get pushed a lot to saying, why isn't the government doing X, Y, or Z? And I sometimes step back and say, do you really want the government in this space? Or do you really want government out of this space to allow you to make these investments? And I do think making the market work also means that sometimes it shouldn't be where the government starts, it should be where the market starts, and then government catches up and says, how do we get the policies right to make sure more can happen? But so I want to push on that, because I don't think it quite exists that easily. I think it's easy to talk in these forums where we're all talking to each other, but the market's a lot bigger than ourselves, and when we think about the rest of America, or the world, we should think about some of that.
Mm-hmm. I just wanted to pick up, and before we go to questions from the audience, you mentioned sort of one vision of how things would go wrong if the government really steps in and sort of controls things in a way that doesn't allow the market to be unleashed. And I think, Kofi, you had mentioned the need for infrastructure, and Ron as well. What are the other components? One is a good relationship and an effective way of working with government. What are the other sort of priorities that you would see that need to be in place, whether it's pieces of infrastructure or other aspects of infrastructure you mentioned, that would really need to be in place for us to capture this opportunity and not to see it be derailed?
So if I could just come back on something that you said. I don't think the key here is that investors are all there. I don't think that's even necessary. The question is whether there are a sufficient number of investors with sufficient market power to make a difference? And I think the answer to that is yes. Maybe what you're describing is necessary to get an even greater number of investors to be there. That's possibly true, but that's not a necessary condition. My argument is without wanting to repeat it, but just coming back on your comment about whether or not philosophically people are there or not. My argument is the following. There is a very strong culture of venture capital that exists, particularly in the US, but also in some other countries. The challenge, I think, is to try and get that culture to be recognized as a driving force for the achievement of things which today are seen as charitable or philanthropic objectives. That's the challenge. Now, I think that is happening. And the reason it is happening, I think, is because there is a natural limit to two other uses of capital. The first is simply investing in established businesses over and over again and driving the price up. At some point, a Microsoft share is just too expensive, or Berkshire Hathaway stock is just too expensive. So that has a natural limit imposed by the market. And the second is arbitrage, where there is a recognition that the creation of new financial products, regardless of how irrational they might sound, selling mortgage securities to people with no income, no jobs, and no assets is one of the most irrational things one can think about. And the idea that capital will continue to flow into those sorts of asset classes, I think also has a natural limit, and that natural limit is caused by failures. So with those two natural limits in place, it is not surprising that there is a sufficiently large group of investors, and I agree that it may not be all of them, but a sufficiently large group of investors who are looking at ways of moving capital into areas which have, to date, not attracted as much capital as they ought to. And those are the areas which I believe impact investing is highlighting. And to my mind, that is a trend which I expect to continue, driven by the market and by the necessity to allocate capital, not driven by government, which may have a separate objective of widening that pool of investors beyond the natural pool that I'm referring to a much larger group.
One of the key things I think about building infrastructure is I almost feel like sometimes I'm in a translator function, because I'm attending various different types of groups. Yesterday I was with a group of 300 CEOs of the financial services industry. And I was kind of trying to explain to them what is this new field that many of them haven't heard of. And now today we're with a group that's very steeped in the social and the environmental issues that we're trying to solve, and perhaps not as familiar with what types of financial vehicles can be used. And so I think that translation function is incredibly important. One of the reasons why we formed the nonprofit that we did is we felt there needed to be somebody in the middle that had what I call financial cred and social cred. That to do this right, the financial industry needs to look at it and say, there is a group of people involved in this initiative that understand that these are financial instruments. They're sitting on clients' investment portfolios. Irrespective of how strong the social or environmental purpose is, they can't be disguised grants. We can't be talking about, it's a great investment, but if you lose all your money, you're still going to do a lot of good with it. What I look at in my foundation is we make a lot of grants to early stage type programs. I'm looking at what's the next microfinance. Is it clean cook stoves? Is it community owned water facilities in Africa? Many things need to be grant funded until the point where they reach a critical mass where they can become investable. But we need to be able to help investors understand this is a grant and this is an investment. But at the same time, we need to have that social environmental cred, that it can't, this industry can't be built by 10 financial firms building products and hoping that there might be some social or environmental value. So it's really bringing together the right folks. And to Sonal's point, I think the government has a role in kind of evaluating both enabling policies that could be put in place, and also, perhaps even more importantly, policies or structures that are in place today that are keeping capital from potentially being deployed. Investment managers talk to me a lot about, well, geez, I'd love to do that, but I'd be violating my fiduciary duty, so I'm not going to do it. Now, the Department of Labor has set out all kinds of fiduciary regulations about working with pension plans, et cetera. And it's funny because in my own foundation, I actually believe that we are violating our fiduciary duty to those dollars if we're not investing for impact. If we've got 100% of our dollars and we're investing it conventionally and we're saying what the good that we're doing is just limited to this 5% slice, I don't think that we're justifying the fiduciary role that we have in running that pool of money. And that's a conversation that I have regularly with top 100 CEOs of major foundations who say our investment department is on the 18th floor, our program department is on the 17th floor, and unfortunately there's 2 different banks of elevators, so they don't talk to each other. And
It
that
might
is
be fortunate.
that is unfortunately so true, and I sit down, because of the role that I play, I sit down with the chief investment officer, and that person so often says, well, we just haven't been able to get our arms around this as a fiduciary. And so I think that are there opportunities perhaps in the government to help redefine what it means and expand what it means to be a fiduciary of capital, certainly mission-driven capital, and I would argue at some point all capital should be looked at that way, and those who are the fiduciaries should be looking at all the different components that Kofi mentioned, not only financial, but we have a partner in our venture, a gentleman named Jed Emerson, who's spoken here before. Jed is Antony's co-author on a seminal book on impact investing. I'm giving him...
Thanks for the plug.
I had to give him a shout out, but a book that's coming out later this fall. And Jed has talked for years about a concept of blended value. And I really believe that that's the direction that we're moving, is that combination of blended value. And it may start with a small piece of a portfolio. I think in 5, 10, 15 years, hopefully it encompasses the lion's share of how someone looks at investing a portfolio.